So today we're going to talk about something that I think is going to fundamentally change the way a lot of people, particularly Australians, think about property investment. And I mean first-time investors in particular. Because if you're sitting there right now with the deposit saved up, maybe you've been looking at properties, maybe you've been having a few conversations with a mortgage broker. I want to walk you through some numbers that I think you absolutely need to see before you make a move. We're going to look at what it actually costs to hold a median price investment property in today's market. We're going to look at what the rental market can realistically deliver back, and then we're going to look at this from the tenant side, because the tenant's financial situation is just as important to your investment as yours is. My name is Richard, and welcome to Ron's Industries, where we're pro-wealth, pro-growth, and pro-real estate. And today we're going to go through the question, is single-tenant rental a worthwhile investment anymore? Let's get into it. So let's start with the ownership side, and I'm going to use some real numbers here. No rounding things into a flattening direction, no best case scenarios. The median house price in Australia as of 2025 to now is in the order of $900,000, up close to 10% from $820,000 just a year ago. Now, that's a loose number. Now, property is local, and this is a national average. Different countries will be different, but the math here is universal. Prices are going to vary depending on where you are. Cities are going to be higher, regional areas are going to be lower. But 900,000 is our working figure for today in this video. Now, most first-time investors are going to be entering the market on a standard 80-20 loan-to-value ratio. What that means in practice is you need 20% deposit, which on $900,000 is $180,000. And in this video, that's a best-case scenario. Now, that's your entry ticket. This leaves you with a mortgage of $720,000. It was $656,000 just 12 months ago. Now, at the current principal and interest rate of, say, 5.7%, what does that mortgage cost you every month? It's going to cost you $4,179 every single month. That's $50,147 per year just to the bank. That's before you've paid a single council rate, before body corporate, if it's in something like an apartment, before any repairs, any property management fees, any insurance. That's just the loan repayment. So that's your floor. That's the minimum that this property is going to cost you to hold. And as I said, with different LVRs, it's going to get worse. Now, let's flip to the income side, because obviously the plan is that the tenant is going to be contributing to those costs. A healthy market rate rental yield on a property in Australia right now sits around on average, about 4%. On a $900,000 property, that gives you approximately $36,000 per year in rental income, or put another way, about $692, or let's round up, $695 per week. Now, here's the number I want you to really sit with. To cover just your mortgage repayment, nothing else, just the bank, this property needs to achieve a yield of 5.57%. At 5.57%, you'd be collecting around about $965 per week in rent. The market rate that we're looking at is $695. You would need $965. That's a gap of $270 per week. Or if you annualize that, you're looking at a shortfall of around about $14,040 per year before you've touched any sort of holding costs. Now, for some investors, particularly those with significant equity elsewhere, a negatively geared property is part of a deliberate strategy. I understand that. But for first-time investors who are also paying their own rent on their own mortgage, that's a $14,040 hole that you're filling from your own salary every year before anything goes wrong with the property, and it does. That's the reality of where the numbers sit right now. Now, this is the part that I think a lot of investors miss, and this is critical because the sustainability of your investment doesn't just depend on your finances. It depends on whether your tenant can actually afford to stay. A vacant property doesn't just cost you rental income, it costs you the mortgage repayment you're now making on an empty asset or liability. So, understanding your tenant's financial position is directly connected to your investment risk. Now, let's look at the numbers. The average Australian salary is sitting around about $105,000 per year gross. After tax, that's approximately about $83,000 in take home pay per year. Now, at a market rate rent of $695 per week, which is $36,140 per year, your tenant is spending around about $44,000 of their after tax income just on housing. That's already a stretch because financial stress typically starts to set in meaningfully above 30%. But now let's go to the scenario where, as a landlord, you might need to push rent to cover your mortgage because, say, there could be a change to negative gearing where you can't claim mortgage payments as lower income, where you would pay full income tax and then effectively subsidize the property for the tenant. At $965 per week, that's $50,180 per year. On an $83,000 after-tax income, your tenant is now spending nearly 60% of everything they earn after tax on rent alone. Now think about what's left. That's $32,500 for the year. That's food, transport, phone, utilities, health, everything. And that's for someone on the average salary. For someone earning less, this number goes to zero pretty quickly. So, what this tells you is that the pool of tenants who can realistically sustain rent at the level that you need to cover your mortgage at the current rate of growth is shrinking. And a shrinking tenant pool means potentially longer vacancy periods, more competition to attract tenants, and increasing pressure to keep rents at a level that don't actually serve your investment. Investments that don't perform lead to stagnant markets, and we know where this ends up. Both sides of this transaction are feeling the squeeze. This is important to recognize. Now, here's where it gets really important for anyone thinking long term because this isn't a temporary problem. This isn't a blip that's going to correct itself in 12 months. Australia is running a structural housing shortfall, rising to approximately 60 to 70,000 dwellings per year. Now, there's not enough new housing to meet demand. That puts a continuous floor under property prices, which means that the entry cost for investors is only going to increase, something that can't be supported in negative cash flow positions. Now, here's the circular dynamic that plays out. When interest rates rise, fewer people can service mortgages, so more people are pushed into the rental market. Higher rental demands push rents up. When rates eventually come down, people return to buying, competing for limited supply, pushing prices even further up. And as prices go up, the deposit and mortgage costs increase. Yields need to climb, rents need to follow, and the tenant's capacity to pay eventually hits a ceiling. Now, that ceiling, based on the current numbers, could very well be around the $50,000 per year in rent mark for the average earner. On a median price property at today's rates, we're already approaching that zone. And it's not just Australia where the property dream is fading fast. For first time investors, the message here is straightforward. The longer term trajectory of this market rewards investors who structure deals that work at the current yields, not investors who are counting on the traditional rent increases to eventually make unsustainable deals work. So, what are the investors who understand this actually doing? Because smart money doesn't sit on the sidelines, it adapts. So, what we're increasingly seeing is a shift away from single tenant rental model towards rent by room strategies. And the numbers here are genuinely compelling, even if it might make you hesitate for other reasons. Take that same 3 or 4 bedroom property. Instead of renting it to a single household or a couple at $695 per week, you rent each room individually. At $320 per room per week, which is a reasonable market rate in many Australian suburbs, the 3 bedroom property generates $960 per week. 4-bedroom generates $1,280 per week. Now let's put this into context. At $960 per week, you're covering the mortgage on our $900,000 example property to within $20 per month. At $1,280, you're cash flow positive before holding costs. The same asset structured differently produces a completely different financial outcome. This is why co-living and rooming house strategies are moving from fringes into mainstream strategies. It's not just about lifestyle or social trends, it's a mathematical response to a market that has made single tenancy increasingly difficult to justify, let alone support. And here's the kicker. Banks are starting to cotton onto this. Lenders are more willing to finance properties that demonstrate clear serviceability. A multi-tenancy strategy that pencils out to cash flow neutral or positive will attract finance more readily than a single tenancy arrangement that requires the borrower to supplement from their salary indefinitely. So let me bring this together with 3 things I'd want every first-time investor to take away from today. Number 1, run the yield math both ways. What does this property earn at 4% yield? What does it need to earn in order to cover the mortgage, say, with an extra 3% in the case that the world has another anxiety attack? If the gap is significant, then go in with your eyes open about what you're committing to subsidize. Number 2, think about your tenant's capacity, not just your own. A property that demands more than 40 to 45% of the average local salary and rent carries vacancy risk. Know your tenant market before you commit to a price point. Number 3, ask whether multi-tenancy is an option. If you're looking at 3 or 4 bedroom property, understand the zoning, the layout, and any of the rules, including building classes and building codes. The ability to pivot to a room by room model could fundamentally change the viability of a deal. Now, the single tenancy investment property isn't gone, but the era where it more or less financed itself on a standard yield is under real pressure. The investors who will do well in the next decade are the ones who match their strategy to the market that actually exists, not the one from 10 years ago. Now that's it for today. Thanks for watching, and I'll see you in the next one.